Hey guys, it's Cameron here with Emerson House Buyers. Every week covering tools, tactics, strategies, lessons I've learned, things that helped me build up a sizable rental portfolio in about 2 years. Today I want to talk about reasons not to do something. So if you're having trouble with deciding on something, or maybe that's what you want to do in life, or should you make the investment, something that's really been beneficial that I've been using recently is creating a not to do list. So I've heard Elon Musk and very other successful entrepreneurs mention this. Decide what you don't want to do first. And that way it will leave room and kind of wean out at least some things so you can decide on what you do want to do. So why can't you do that in real estate? Why couldn't you do that with your real estate investments or any other investments that you're making? So I created a reasons not to buy rental list. I'm going to share those with you. But what I did is then I took each reason to not buy a rental, and I basically said, how am I mitigating that risk? Or am I okay? Am I going to live with that? For the return I'm getting, can I live with this? Knowing what I know, can I live with that? And for me, each investment has still passed this test, but it was something that at least you kind of put both sides on the table. You're always looking at it in the positive light and what can go well and how much money can I make? And you kind of turn and you shift your focus and say, okay, why should I not buy this? And then if you lay out all those things and then write down, take some time, say, okay, how do I mitigate this from happening? Or if you can't, am I okay with that risk? That is huge in this. Then you will hardly ever get blindsided. You'll know the advantages and you'll know the cons. And if you do get blindsided, well, then you'll just have to adjust it for your next time, for your next investment or the future investment. So, reasons not to buy rentals: excessive repairs, right? Bad tenants, bad property. It's just it wasn't good. You either underestimated or the tenants you put in there are terrible and they're tearing it up. So what can you do? You can screen the tenants and conduct inspections. You can do preventative maintenance. You can do proper work. Sometimes the work people do is shoddy and it causes excessive repairs. Number 2, you can't find tenants. Markets can change. Employers leave. Risks, things happen. There are things that, tenants leave. We had it happen in Houston with the oil crash. So what can you do? Rental rates that the average family that you can afford, so make sure your rental rates aren't too high. You can bring those down. You can use a lease agent. So if you're putting the sign in, you want to make sure that you're having struggles with that, go up to the next level, use the MLS, use an agent, and get them to help you get your message out there to more people. And buy in desirable areas. So you want to own places where people want to be. You don't want to be in Podunk, wherever, out in the boonies, because if something changes like this, you're not going to still have the desirability. I think you're always, no matter how stupidly high the prices get in San Francisco, Miami, New York, you're always going to have people there. Number 3, the rent prices drop. You can purchase homes below average rent rates. So basically, if you buy and the rent purchase homes below average rent rates. Yeah. So if the average rent is say $1,500 a month, and you buy $1,000 a month rental, if the average market comes down, your rental will still be filled. So if you buy a $2,000 a month rent, right, and that's at the high end, and the rents come down, you're going to have to go down to the $1,500 a month average. Whereas if you buy a little bit below that and stuff starts coming down, you won't be hurt nearly as bad. And then the other one is just financial management. So if rent prices drop, have enough revenue to sustain minimal price drops without your negative cash flow. Because when you get too tight, when your rent is here and your expenses are right here, and the rent drops, now you got to come out of pocket to cover that difference, and that could really get you in trouble. Next thing you know, you got to come out $100, $150, $200 a month. You have that happen on 4 or 5 properties, you're in big trouble. Interest rates rise and property values decrease. So have excessive revenue to sustain higher mortgage payment. So if you have some variable rate mortgages and interest rates come up to borrow money, then you want to make sure you have have some wiggle room, have some basically excess funds. Cash, have some cash on hand to buy out your ARMs, your adjustable rate mortgages. So if you have those, if the interest, and basically I want to clarify, when I say interest rates rise, I'm talking about mortgage interest rates, okay? So when a mortgage interest rate rises, that means your monthly payments are going to go up. That means typically housing prices go down because people cannot afford that higher monthly payment. So the housing prices come down a little bit, so it's the same monthly payment as before. So you have your cash to buy out your ARMs, you have some revenue, you have a good balance of fixed rate mortgages and adjustable. So if they do go up, you still have a strong base of your portfolio or some of your portfolio that's diversified. So when the payments of these go up and you get pinched on the cash flow, you still have a good, strong fixed rate mortgage. And then the last one for interest rates is the proper use of leverage. So you want to make sure that you're not overextending yourself, so if something does happen and the interest rates do come up, that you're not getting pinched. You're still okay. Then which leads us into the fifth reason not to buy a rental: over leverage. So people get, oh, borrow, money's cheap, borrow as much as you can, and next thing you know, you can't cover it. You're asset rich and cash poor. So you want to have cash reserves. You want to make sure you're doing proper accounting. It is very, very, very easy to not know your true numbers on a rental property, especially when you have a couple. It's very, very easy because you've got taxes maybe paid at the end of the year. You're getting some cash flow throughout the year. You have an expense, nothing, $500, nothing, 1,000, nothing. I mean, you've got to be very diligent about how you measure cash flow. So proper accounting. And then basically this over leverage, it's the balance sheet, leverage to equity. So you want to make sure that if you get over leveraged and you can't make the payments, that you have some equity in the portfolio where you could sell some things and pay that down. So basically just proper debt to equity ratio or debt to asset ratio. You want to make sure you have some cushion in there. So number 6, it's a large investment of your time. So again, rentals can, if you let them, take a lot of your time. So you can hire people, hire managers, property managers, contractors, agents, wholesalers, that whole ordeal. You can create systems. So again, you hire these people, you want to create systems, make it easier on you. And the last thing is you train your tenants. So from day one, you say, it is due on the 1st, late on the 2nd, or due on the 1st, late on the 3rd. Whatever your rules are, you want to sit down and make sure that they understand and have the proper expectations. Because if your tenants are crazy, you're going to spend a lot of time if you don't teach them from the get-go. And I'm not saying that I don't mean that in a negative context, but just like with anything, when you first meet somebody, if they set expectations high or expectations at a certain place, you know that you have to deliver there, right? Number 7, large investment of capital. So another reason you're going to have to fork out 20-25% to buy rentals, right? Well, we can do the BRRRR strategy, the buy, rent, rehab, refinance, repeat strategy. I mentioned that in another video. If you're not sure what that is, go look at that. You can have excess reserves, again, to have more money saved up to be able to afford those down payments. Low amounts of bad debt. So again, if you go out and you buy cars, trying to think of anything, furniture, there's all sorts of stupid things you can do. Credit card debt. Anything you put on a credit card or a depreciating asset is bad debt. If the debt is not being financed or paid by somebody else, then it's bad debt, right? So you want to have low amounts of that so you can afford to make good investments like real estate. Number 8, manage people. So again, you're going to have to manage contractors, agents, inspectors, insurance folks. What can you do? Again, train your people, set expectations at the front. I want you to do X, Y, and Z. If you can't do that, and you don't want to say this in a rude way, just be like, my expectations of you working with me as an agent are that you're going to handle everything. Here's my lease that I want. Handle everything on the front end. Take all the phone calls, do all this, and hand me with a lease with a properly screened tenant to this criteria. And if they say that's too tough or that's not how I work, say, do you know somebody that operates that way? Or reach out to investors and find people that have a high level expectation or have I guess the professionalism that you do. Especially if you're new in this, you don't want to go out and hire people that don't know what they're doing or are new. You want to hire experts. You want to hire people that can teach you a thing or two. So be cognizant of that. Again, you can create systems. We mentioned this before. And number 3, I kind of got a little bit ahead of myself, but hire top talent. Again, hire those people that have a lot more knowledge than you, and they can share some things and make your life a lot easier. And then 4, grow. Take some courses on public speaking, on management, on systems, on business. When you own a rental property, you're technically an entrepreneur. I mean, it is a business. That house, especially when you have multiple, those are properties, those are assets. You have debt against them, or not maybe, but those are, you have to treat it like a business. If you treat it like a hobby, you're going to get in trouble. The last one, illiquid, which means that unlike a stock where you can buy in today, or when the market's open 9 to 4, 9:30 to 4, you can buy in whenever in between that time frame, and you can sell in that between that time frame. Some investments will take a day. Some of those mutual funds, ETFs, etc. Some of them you can trade that same day. You can trade within the same hour. Real estate is illiquid, meaning that you have to go out and find a buyer. You have to go out and say, okay, there's a $100,000, $200,000, $300,000 investment here I'm trying to sell. I've got to go find somebody to pay that. I can't just go get my money like this and walk away with it today. So again, keep cash reserves. This is how you mitigate that. Keep cash reserves. Have a good debt to equity balance sheet that we talked about earlier. And again, have a balance of fixed and adjustable rate mortgages. So if you need some cash, you're not going to worry about inflation rates or anything else. That is how you mitigate. So guys, those are the 9 things, the 9 reasons not to buy rentals. I think I'm going to turn this into a blog post. I'll link to it if I do. Because if you can answer these questions and walk through this whole thing and are still comfortable with the investment, and you take the proper, like I said, I just listed these out, just started 1 through 9, boom, listed them out, and then I said, okay, how do I mitigate each of these risks or reasons not to? And boom, a proper system, screening tenants, balance of fixed to adjustable rate mortgages. You put all that together and you look at each one and say, yeah, I'm doing all that, or I've done enough of these that I'm comfortable buying this rental property or these rental properties or this apartment building or this stock. You can do that with anything. But use this strategy, guys, the not to list, the not to do or reasons not to list, or I guess frame of reference. And that will really, really, we get confirmation bias where we start looking at all the positives and what can go right, but we don't think about what can go wrong on the other side. And inevitably things will go wrong. Nothing will go perfectly right. I hope you enjoyed this, guys. If you did, let me know. If you didn't, let me know as well. If I'm just speaking gibberish and it doesn't make any sense, please let me know. Appreciate it, guys. Hope it was helpful. Talk to you next week.